Rolling into another week, John. What are we talking about today?
We were gonna talk about all the other markets, but we're gonna do one more grain week this week. I think this is gonna be an important month. I want to talk about it. What to do with old crop and new crop, beans and corn, because that's what everybody's gonna be asking. So we'll hopefully have some answers. What to do this month specifically for corn and beans.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, I have been in a class all morning. I have not looked at the market since 9 o'clock last night, so I hope you came prepared today.
Yeah, this day flew by, but when you're looking at the grains, it just all blends in. There's just not a lot going on.
You're saying I didn't miss much?
No, but that'll lead us into what we're going to talk about this podcast. Let's take it month by month. I think this is a market that you know exactly what it's going to do going 6 months down the road. There's a little crash on the connection there. But you just want to take it day by day. And so a lot of the calls that are going to come in now are, the old crop corn, old crop soybeans. Makes a lot of sense. What should I do? Should I sell? And guys are trying to line up prices. So that's the topic of this time of year. Now, what I think is going to happen, I'll tell you. I got a prediction this month. We had very unseasonably cold weather, even for here, which is saying something.
Yeah, something.
And then the rest of the United States. So very little grain has been moving around the country, but a lot of grain needs to move around the country. They need to raise money for the next year's crop, but the weather was a very convenient excuse not to move anything, and it wasn't a good price. So you did, and you look at the March-May corn spread, which I've talked about a lot, and that is your gauge to what's in the commercial pipeline. At 7.5, 8, sometimes it fluctuates to -8, means March is 7.5, 8 cents under May. What's normal? I'd say, 9-10 cents is normal in a bear year. And last year, it quickly widened out starting this month to -14. It was at negative, 7.5, December 19th. Then the market started rallying in corn. The market went up, and it went up aggressively in January. And farmers, producers took the corn and they brought it into town. And they brought it in big groups. The reason that's not happening this year is because the price isn't good, but the time's ticking. So the spread shows you that the corn is definitely not moving into the pipeline versus the demand. But it's not so bullish that you're going to get inverted and fly out of here either. But what does it tell you? It tells you that this corn market very easily could rally 15-20 cents. Very, very easily. There's not enough in the pipeline, or not enough to put carry in that would normally be here, which indicates there wouldn't be enough. The end user, on the other hand, knows it's out there and he's going hand to mouth, but it's still not coming in fast enough. So it's more likely to go up than down, seasonally speaking. Fundamentally, short-term speaking, not long-term, we should see a rally. Now, this is the rally that I want to use to start getting stuff on. And that's where I think, and we've talked about this last podcast, that's where a lot of guys are. What should I be doing for this year's crop and next year's crop? I think this month is going to be pivotal in decision-making for old crop and new crop. And I did send that letter out, the Blue Creek letter, to clients and subscribers of the Hedge Heads. And basically what it's saying, and it's the first sheet of a few that I'm going to do, is basically you have to decide over the next few weeks whether you're going to go for it in the summer and just see what happens with the price, or you're going to start, hedging, and some bushel hedge arrives. You're going to start moving old crop. What exactly is your plan? Are you holding all the way to what potential weather problems for the big payday, which there certainly could be, or more realistically, do you need to raise capital for your operation and you need to start selling? So now we're going to start looking at levels that make sense here. And I did put those levels in the sheet. You'll see them for March, the recommendation for March, and then you'll also see the recommendation for December 26th. Another contract I have my eye on, though, is March 27 for new crop. That's right in your 470. If we can get that 20 cents, let's just say we get 15 cents back there. We're close to 485 for next year's March, and you really gotta think about, is that enough for me? But here's the best part: even if you pull the trigger, and this is where we differ than just pulling the trigger. Is it worth re-owning? And that's what I want to talk a little bit about.
There's certainly opportunity to re-own.
Yeah, and is it wise to re-own? And that I think a lot of guys have problems with simply buying corn calls and not making money. I think that happens all the time.
It does to me.
Yeah. You can't corn is not the kind of market, because of the way the options are priced. You need a move to make money. Like, I know that sounds silly, but you can't expect to buy a corn call, move 12 cents, and expect to make a lot of money. It's already hard enough to make money in corn calls. So you get a bear market like this, it's tough. Now, is it wise to re-own it? And I think it's going to be. I think that a guy should really be looking at these September options after you've made sales. Let's say, just for example, you locked in 465 December futures for next year, right? You're going to hedge to arrive at, forward contract at, whatever you're doing. At this point, I want to turn around and look at buying calls. And let's just say we can get a 470 for 12 cents, just for argument's sake, even though they're like 15 cents. What you want to do is hold that call until you see some weather. So in other words, instead of making that sale final at 470 or 465 and locking that in and not having the upside, have upside for a little while. But don't use short-term options for that. I don't think that works. I think you have to have something that has the whole summer weather in there that's going to hold its value. So let's run through a quick scenario. What might happen? Farmer A, he runs through where he sells his grain, and he gets a hedge to ride contract for March. He's locked in there at 475. We'll just use these nice round numbers for easy math. He turns around and buys a 470 September call, which expires in the third week in August. So you follow me? So worst case scenario at this point is going to be 475 minus 12 cents. That's if everything goes wrong with the plan. That's the worst that you're going to do for your futures is your 475 minus your 12 cents. Now, what's likely to happen is we wander into spring, and let's just say it's good. Not a lot going on. The price hasn't gone down a lot. It hasn't gone up a lot. That option that you bought for 12 cents is now probably worth 8 to 7 cents in the first week in June. At that point, if the weather's really good and it looks like there's no threat here, and I don't want to own these calls, you can get rid of them. So you really, at that point, you owned a call for 4 cents. You gave up 4 cents of the bottom line, but you had your upside open, and that's what I think is really important. My whole point is, guys will make a decision here on whether to sell or not, and that's fine, even if it's 10% of production or 20%. But decide whether you want to have that upside open, even if you do lock that number in for a little length of time. Don't run out there and buy a May call, because you're going to run out of time before you see any weather. You're going to be tempted by that cheaper price, but you want more time to see the weather develop, and then at that point decide whether you're going to hold the call or not. Now, if you hold this call all the way to mid-July and it's raining every day, you're going to lose 12 cents. But if you just piggyback it, it expires in the third week in August, but let's say you're in the second week in June, which is where we top out quite often. If nothing's happening by then, you might want to get rid of it, and then at that point you have 475 minus 6 cent loss, 469 worst case scenario. And why is this a lot better than just walking away and selling it? Say, I'll take 475 and that's good with me, because you haven't seen any weather. I mean, it's really simple. It's hard to hedge because you don't want to, because you haven't seen any weather. But if you don't hedge, the price could start sliding on you, and all of a sudden we might be fighting for 475 later this summer with a weather threat. Fighting for the price that you can get right now. Now, that all being said, these aren't very good prices, and that's kind of where we sit officially, as we haven't done a lot because these just simply aren't very good prices. What are your thoughts on it, Ryan?
It's hard to summarize it more than what you just said, because I'll say my one thought from what you said is I still prefer the July contract. I understand your reasons for the September contract.
Yeah.
I did just pull it up. So
What's a July 470?
First of all, July and September are actually almost identical in price right now, which is interesting. 442 and a half, 442 and a quarter for July and September.
So you get less time with the July, and then what's the price I have?
So the July 470 is 9 cents.
Okay.
With 9 cents today, 143 days. September is 15 cents, and you have 199 days.
The only potential problem you have with that is the time frame. Let's say there is a weather event happening, and the July call is working. At that point, though, you're in the third week in June. At that point, you'll have to decide whether you want to be long futures, and that's the big difference.
Yep. And that's, to me, that the reason I like July 1 is that price is more reactive to that weather than the September price is, especially when you get to June.
Yep.
So, yes, it's true that July and September are really close right now, but if there's a weather event, if there's something going on, typically July well outpaces September in that, especially in the late May, early June timeframe. Secondly, it's a little bit cheaper.
Yep.
Where it doesn't help is if that weather event or something does carry on beyond that third week, or even really realistically into that second week of June, if it still looks like it's going to continue, then yes, you need to decide right now what to do with the option versus having the September option. You are able to wait and see. But to me, for the price, I still lean towards July. I like the way July reacts better than I like September. But that's just a difference between you and I.
Yeah, and we've gone over a million times. Quickly, I bought July, a bazillion July calls in 2012. Everybody had them. It expired worthless. It went down to the third Friday. In the one drought year we had, the July calls did not work. Not a cent was made on those. So that's why I have a sour taste, and we do talk about that quite a bit. But that's for guys that have.
Could have bought September calls that day and made the same amount of money as buying them back in.
Yeah, well,
just to be
clear.
The
truth is, it was hot and dry, and it did seem like it was going to go up, but no one understood exactly what was happening there and why it wouldn't go up. You could have bought September calls at that point, but what I find is if guys buy July calls and it doesn't make money, nobody's in the mood to extend that coverage.
Absolutely. I totally get that. Yeah. To me, I prefer the July contract. There's certainly reasons to do both, and that's where it matters what your goal is and what your time frame is.
Yeah.
I mean, there's not one answer for every farm.
I find that guys are attracted to the cheapest ones just kind of automatically, and they lump all.
That's not the way to do it either.
And they kind of lump all the months together. They know like, it's like summertime, July sounds good. Like that's an important time frame. That's the third Friday in June. There has been some July spikes after that, not too many. The truth is most of the highs do come in before that expires. But the one drought year, if you would have had September, it actually forced you out on the high. Like in the third Friday, it was the third Friday, I believe, was the high in the corn market that year or near it, around 840. And it would have you would have had been long futures, it would have exercised into futures, or you would have had to exit, and it would have basically forced you out in the high. So it worked out perfect that year, but every year is different. I just like the forgiveness of the length of time. You have time, and we should go back and go to the March one that we talked about versus September ones. Remember a number of episodes ago we were talking about how March is cheaper and it's more tempting. Yep. But I like the September options. Now, all those guys that chose March over September, all those calls are going to be worthless.
Yep, absolutely.
The September ones were more money, but they have lost 6 or 7 cents, but they're still in the game. And that's the big difference between, you have to have your time frames right if you don't have enough time. So I usually err on the side of too much time, and that's what I'm doing in feeder cattle. I put out a sheet about looking at September feeder puts. Other guys want to go to May, and it's a lot cheaper, but I chose September because of the time. And this is a spec trade. This is not a hedge, actually.
Right.
And I just wanted I wanted that whole window to be right in.
Yeah, but how much are September feeder puts? Like $37,000?
Everything's insane. Everything's insane. And it's just like, but it's insane, but it's not, because it just happened where the ones that were way out of the money, the $3 January puts, I know this because guys had it on, went from $1,500 to something ridiculous really fast. So it just happened, and it wouldn't take much for that to happen again. Now, of course, we can start talking about cattle. That's a whole different ball of wax there. But I like to err on the side of having enough time.
Yeah.
But if you time the shorter term options good, you can make a lot of money.
Just to be clear, July is not short term right now.
No, but
you're talking March, and there are guys who want to buy the April calls now. They want to buy the May call,
yeah.
And I'm not saying July because it's shorter term. I just like the July better. And the other part is the production year.
Yeah.
July is definitely old crop and old crop influenced. September is a borderline. It's technically old crop. Maybe it's new crop. The price just reacts way different, especially when you get into summer.
Yeah. Yep. And there's other things you can do too. You can do nothing. And there's another strategy that you can do is short-term options or short-dated options. It's the worst name ever. I say that all the time.
Yep.
And it basically what it is like new crop December, but different time frames. You could choose if you want to protect the price through May, you could do that. So that's another thing you could do. It's like, hey, I think corn could fall. I want to buy coverage, to the downside through May. But in my opinion, the front's going to fall faster than the back end anyway. I don't think there's a big need for short dated stuff.
Not this year.
No, so you could use your old crop.
The short dated ones are great when you're in the middle of the Ukraine war when that broke up.
Yeah, and you have inversions, and there's definitely times to use it. This doesn't appear to be a need. What worked really good last year was some guys sold some 480 July calls, and about this time of year, it looked like, boy, that was really wrong. That's a terrible trade. And then they turned around and bought, I don't remember, 450 puts, 460 puts. And then it initially went in the money, but ultimately the Julys expired worthless. And then they had coverage from 460 on down, which you needed last year. So I do think that markets could be headed again to something similar last year because we have a similar setup. We have a lot in storage, a lot that needs to get sold, and everybody in the entire world knows that. We have a very good demand, which is keeping this price above a very bad price. It's not like it's a good price, but it's good for 2.2 billion bushel carryover.
Right.
So we're kind of just go round and round with these grains.
Speaking of grains,
yes.
Just to head you off here, because we spent the whole last episode on corn too, and I understand corn's important right now, but I know that you have an appointment later, so
I have a dentist appointment.
Oh man. And he didn't schedule it for 2:30.
I rescheduled this one like 3 times, and I'm like, I have nothing going on that day. And then all of a sudden, I did have something going on that day.
All right, sounds good. So I do want to hit wheat's actually been moving up. Yep. Soybeans, that 1060 level, it's bounced pretty hard off exactly 1060 twice.
Yeah.
Anything you're watching on either of the other two main grain contracts?
Yeah, we what's worked really good is is to trade the range. Whether you're in futures or selling puts when it goes down to 495, and then riding it up and then selling calls on the other side or shorting futures once it rises. I don't know where the resistance is. It usually rises 30 cents, 35 cents. Like playing that range has been the winner in wheat. There has been no other winner in wheat at all. Like you just simply play the range however you want to. Whether you want to use mini contracts, micros. I've never seen anybody use a micro grain yet.
Not a micro grain. The mini wheat is, if
there's just enough there to do a little damage if you want to entertain yourself with wheat.
Yeah, but on top of that too, like for guys who maybe are new to futures, there's enough action in that one to
you're learning.
You're learning and feel what it feels like to be actually losing money.
Yeah, exactly. What I don't like about these markets, and we haven't been talking about them a lot, is that they're going nowhere fast. And not only that, both of them could go either direction very easily. Beans
it turns out the volatility guys were right.
Yeah, the volatility guys are implied volatility guys are right. This is just stuck in for frame of reference. This is a extremely strong time of the year for grains.
Yeah.
Beans tend to top out coming into February. They used to call it the February break as they look forward to the South American crop or the supplies coming online. But this is normally a very strong time of year. So it's kind of pathetic that we're talking about, these tiny ranges and trying to sell 20-cent rallies if we can get it. I wish there was more to talk about in beans and wheat, but there really isn't a major story there. Beans have the biggest story, 81 million acres. Beans could actually get tight in the spring. This is something no one knows, and we've talked about this many times. They're not going to tell you, hey, we're a little underbought, at the crush plant.
Charlie, the intern, forgot to put orders in.
Yeah, we don't have enough, so if you just hang on in the storage there, we're going to pay you through the nose in May. They're not going to do that. So if they're underbought, you're going to see it. They're going to need it. Not only that, we have a lot of exports on the books for beans, believe it or not, in a very quick window because of China coming in and the rest of the world. So we need to ship all this off. We need to get the ice off the rivers. We have a lot of problems to go with beans, but it does have a very good bid under it right now. That will remain until the bid goes away. I don't expect a large break in beans, and as a matter of fact, it could go up very easily. These would most likely be using for hedging opportunities, but for beans, I really feel like you need to see that March number, the prospective plantings, or you have to see how much we're going to have for acreage for beans before you can get terribly bearish.
Yeah.
But I do think it's going to be 3-4 million acres. I think it's going to struggle. And I also think this is a big month for planting. We just don't have good markets to plan with. So we're doing the best we can with what we have. There isn't some secret strategy that people are employing that's just going to kill it. These are just bad prices mostly below the price of production.
I came here for the secret plan.
I'm developing the secret plan, but the best I can do is take this horrible price and then buy something to keep the upside open for corn. But that's the best plan so far.
No, but you talked about that a couple weeks ago, like how there are ways to add a few cents each time.
Yeah.
And also they're not all going to add a few cents, but if you can add a few cents 3 or 4 times before the end of summer, you're going to be sitting okay.
And there's guys that do this nonstop. The implied volatility has really put guys off, but someone sold a 520 March call today, or a few of them, and in return he got 12 cents. So he's saying, I would take that hedge at 520 if somehow it got up there or beyond, and I'm happy with that. But if it doesn't, I get to collect my 12 cents. Now, is that a great strategy? No, but it's what we have this time of year. I went all the way
12
up.
cents is better than 0.
Yeah, and then you can have guys with elevator orders that don't get hit and they get 0 cents. Yeah. Is it a option premier seller's market? It is not. Yeah. Is there things you can do? Yes, lightly, but I wouldn't get too heavy. Now, that being said, we're going to come into a volatile time period, probably in the next 3 months, 3.5 months to 4. And at that point, premium selling is very good. It lines up with seasonals. It lines up with everything. And we'll be talking a lot more of it. And we haven't mentioned much about it just because the last thing I want to do is sell a bazillion calls before summer because I'm bored, and then wind up with a roaring bull market. You're gonna have the worst nightmare that you could possibly have.
If you want to read a story about selling options in a low volatility market, look up, just Google what happened to optionsellers.com, because look it up.
They made a lot of money from what I understand, a lot of years. It was like a printing press until it didn't. And I think the rumor was it was crude oil calls at the same time it was natural gas calls, and then both of those markets went absolutely nuts. Not only did it wipe out like the gains, it wiped out the equity in the accounts, and beyond that, I think most of these people didn't even know they could get a debit. Even though you sign, when you sign the paperwork, you do sign that I do know I can incur debit. So these guys went from like collecting CD money, and like a bunch of old people in Florida, probably old rich people,
right,
to all of a sudden you have not only a margin call, you have negative equity, and you got to put that on. And the guy did end up doing a YouTube video to apologize, but optionseller.com's not there anymore.
No, I mean, it almost took down the FCM too.
Yeah, it was a big deal, and that's what you got to be really careful of, getting bored and just starting to do things. Or hey, I heard my neighbor, he's got all these calls sold and he's going to get all this premium.
I'm going to be short 62 natural gas contracts because it sounds like a good number.
Yeah, this isn't even picking up pennies in front of a steamroller. It's just barely. It's like a half a penny in front of like an atomic bomb. Like you're just not getting very much money, even if it's correct.
No, but I mean, to be fair, when you talk about like selling that 520 call, if you're happy with that price and you're the producer and you have it to put like,
this guy knows what he's doing.
That's where you take advantage. That's where it's smart marketing versus just getting bored and doing random things to maybe make a couple cents.
Yes,
and end up blowing out.
He's done this for many years. This particular gentleman, he's very familiar with the markets. He knows how they move. He would gladly take those hedges at 520.
Yep.
If they were to come in March, and that's just the way he runs his operation.
And it's doing it with a knowledge of what the risk is.
Yeah, and he's been doing it, and they've all been expiring worthless. But again, they don't all expire worthless. You have to expect that could actually be a hedge. What I don't like about selling calls is that it isn't a hedge. You can't go to the banker and say, I'm hedged in this, because this is no guarantee that you're going to be short at 520 at all. And we could go on and on about that. But you do not want to fall into the trap. Like, I need recommendations. I need to be doing stuff and start panicking and doing a lot of bad stuff in front of a spring and a summer, because we don't have any idea what the weather is. And you also don't want to be the guy that's like, well, perfect, they don't know what the weather is, I'm going to do nothing. You don't want to be that guy either. You want to find that balance of locking in some prices, keeping some upside open, and finding these combinations that maybe will work. But it's pretty sparse this year. I mean, I'll be honest with you. This is one of the first years where there's not a lot you could do. Even last year, you had a lot more things going on. Just nobody knew that the bottom was going to fall out completely in February and not recover. It's one thing to have a correction, but this year's providing very little opportunity, and that's just the markets we have. But if there's a lesson to be learned, just don't get bored and get yourself into a bunch of trouble because it doesn't seem like the market could do something. Things change quick. 2019 with the weather, even though it didn't go up that year, if we have another 2019 type spring with all that rain and they couldn't plant, the market wouldn't react the same, because the crop wasn't there this year and that year, and then it took till 2020 to figure that out. The market's going to understand that 20 million acres missing is a big deal.
Yeah.
Way sooner than it did the last time. So never say never on these markets. I'm counting on some sort of weather rally in the summer to some degree to get more hedges on. We're just talking about the first 10, 20% here today.
Yeah. Well, John, we got to wrap up pretty quick here. Do you have final thoughts, or are you ready to?
We'll keep on working with the numbers here to try to make stuff work. We're going to do a show where we're talking about completely different numbers than grains, or different markets than grains.
Speaking of which, we could have. I mean, silver's had an adventure since our last.
The metals have gone insane. Everybody knows about those, though. I mean, you're seeing what $30 swings. Natural gas dropped 29%. This last week. We had a great week trading that natural gas spreads last week, but now that's kind of over. Also, if you're a natural gas trader, that's why weekends in the winter are very dangerous. Exactly what happened. Had very cold forecast going into the weekend, going out in the highs, then opening Sunday night down like 29%.
It was crazy.
Yeah. So, and that was the initial open. So natural gas is real dangerous. At least it's an interesting market. But we'll talk about some more of these markets next time and get away from grains, unless the grains somehow move and make it interesting. We'll make next week's episode entirely about different markets that we follow and trade.
Right. I mean, if your bins are full of cash instead of corn,
yep,
you could have some real fun with natural gas.
Yeah, and natural gas going up is, I'm sure, going to make inputs go down.
Right.
Quickly, cattle before we go, though.
Yeah.
Cattle's cattle. I mean, it's just back in that zombie mode where,
deep.
Yeah, it just goes, it's just like, it breaks a little bit, and then cash breaks out higher, it goes ripping. And then all of a sudden it'll just pause there, waiting for next week's cash, just waiting for it to be higher. Then it goes ripping again. But that being said, we're getting to levels where the danger level, in my opinion, is really high. Box beef's not doing nearly as good as it had been doing. And then we hit the seasonal now where box beef prices generally peak out. So we'll see if that happens. Very hard to hedge that market, very expensive. We are looking at hedges. So if you are interested in that side of it, give us a call and we'll go over them. Just know that everything's expensive and high risk in cattle.
That'd be a great market to have a crystal ball, though.
It would be, because there's going to be money maybe there. There's some spreads seasonally that work, and we're also going to be looking at those and or putting them on. So there's stuff going on in cattle. Give me a call. It'll be easier to talk about it. And off to the dentist I go. That's my fun afternoon.
That sounds super enjoyable. Why don't you leave your phone number, but no one call him for an hour. So.
Yeah, don't call me for an hour. All right, 218-731-1578.
Thanks, John.
Yep.